Good morning. My name is Dr. Kock Lim. So today I'm going to present a topic called impact of macroeconomic and bank-specific factors on the liquidity of commercial bank in Malaysia. So the introduction here basically we are talking about what does it mean by liquidity here. So liquidity basically can be defined as a bank's ability in obtaining the reserve requirement to meet the short-term obligation. This according to Nicolai 2009. Then another one, for this particular liquidity, I'm going to measure using loan to deposit ratio. This according to Regasami 2014. And you can see the graph here, basically the table, you can see the commercial bank in Malaysia for domestic bank basically reduced from 54 in 1980 to 2020 to 8 banks. And for foreign bank, it increased from 12 banks to 18 in 2020. And basically the liquidity here for this particular case, I'm going to measure, I'm using loan deposit ratio according to this what you call Michael Tyler 2012. So the formula is loan deposit ratio is equal to total deposit divided by total loan divided by total deposit times 100%. The problem statement here basically for the liquidity issue is come from US crisis in US subprime lah. So in 2007 and year 2010, and subsequently followed by some issue. As you know, bank could not immediately liquidate long-term liability, long-term maturity assets such as housing loan, personal loan, credit card. They cannot liquidate immediately. Okay, they cannot call back the loan if let's say the borrower pay on time. And another issue is a high loan deposit ratio. This is also one of the issue on liquidity ratio. And if let's say the bank have low capitalization of the bank result in growth in problem financing. So the following ratio, the following problem is the large bank tend to engage more risky activity in order to grow their asset. This particular, like we talk about Malaysia, we have Maybank, we have CIMB, these are the large bank. Okay, and the lastly, high propensity of liquidity risk come for high interest rate, low GDP, high CPI, and also government deficit financing. The objective here, basically, I'm going to look at the impact of bank specific and also macroeconomy on the bank liquidity. There are few elements in bank specific. Basically, here I'm going to please consider the independent variable, bank capital, bank size, and bank leverage. For macroeconomy, I'm going to look at inflation, foreign exchange rate, and government deficit financing. And the significant study here, there are some contribution after we study this case. Basically, they help the central bank to perform monetary function. Then also they prevent bank panic in case as well as bank maintain the soundness and stability of financial system. The next one is it also help the manager making decision in overcome the liquidity crisis. And next one to evaluate the performance indicator can gain more competitive advantage. And lastly is a cushion against unexpected crisis. So you can see the literature review here. Basically, we talk about bank liquidity, capital adequacy, bank size, leverage, foreign exchange, inflation, government deficit financing. So definitely there are different authors come up with a different view of the definition of variable. So for liquidity theory here, basically I'm going to look at bank liquidity theory. So this theory, according to Diamond and David, say investor or depositor are reluctant to take risk and not sure about timing of their future consumption requirement. And the next theory I'm going to look at is the liquidity premium theory. Basically, liquidity premium talking about for extra liquidity premium is an extra return demanded by the investor as compensation for investing in long-term debt, is according to the Macroeconomic 1975. So basically, for the theoretical proposed theoretical framework here, we have dependent variable, bank liquidity, and also bank specific, and also macro factors. So I came up with 6 hypotheses here. Talk about bank capital, bank size, bank leverage, inflation, foreign exchange rate, government deficit, the relationship with the bank liquidity. And for the methodology here, basically, for research design, I'm going to use, I use a panel data for 11 years from 2009 to 2020. And the data collection method, I'm collect the data from bank annual report and also from data from World Bank, especially on the macro data. And the target population specific here, I'm talking about target 8 banks, 8 domestic bank due to the availability of data. Okay, and for foreign bank is I take 10 because some foreign bank I couldn't get the data. And for in order to complete proper result, a BPLM test, Houseman test, and probability test you are using in this particular research area. Okay, so first one, I also do a diagnostic checking. Basically, the diagnostic checking I check on multicolority, heteroscedasticity, and also autocorrelation. For economic trick model here, I come up with this liquidity is a function of those dependent variable plus the intercept and also the idiochromatic error. This is the economic model. And I also came up with the variable and also the abbreviation and what are the definition. Example, we talk about liquidity. I'm going to measure again loan to deposit. Okay. For example, another example, let's say bank size. That means I'm going to take the total bank assets. This is the definition which I use in this particular study. Okay. And the result finding here, basically, I have run some statistics. So basically, you can see from the table 4 here, basically, you can see the table, the result indicate here. The result indicate the skewness value of LTD, CAR ratio, loan size, leverage, CPI, exchange rate are the numbers given respectively and indicate the variable are positive scale and the scale to the right, except one element GDF of minus 0.9931 skew to the left. The rest all skew to the right. Okay. Then for result analysis here, basically I'm using the model, 3 particular model, POS, FEM, and REM. So you can see here the result given. The first one is on the panel regression result. The second one is the diagnostic test. Okay, compare the result here. The result, basically they say POS conclude the CAR ratio and leverage show a significant in negative affected the liquidity. And for loan size, exchange rate, CPI, and GDF were insignificant. For REM and FEM conclude that the CAR ratio, the LEV, exchange rate, significant affect the liquidity. However, the impact of CAR ratio and LEV were negative, whereas exchange rates are positive. So result shown the loan size, inflation, and GDF were insignificant. So the choosing the model here, basically as I mentioned to you here, we run the BPLM, we run the Houseman, we run the probability test. So since the results shown that BPLM and Houseman test confirm REM is prefer. Therefore, for this particular one, I'm going to use REM is a finalized model for this study. The discussion here, we're talking about capital adequacy. Basically, we talk about the result here show negative relation and significant impact which consistent with other previous researcher. Bank size also same thing here. Positive relation bank and bank size are supported by other other previous researcher. They are supported. Okay. And bank leverage basically is a negative relation and significant. So here, the coefficient of leverage is negative on bank liquidity, thus stated against the bank management hypothesis. For macro factors, basically here, it's also similar. The result is quite similar to other researcher, like inflation is similar to this Taganesh and also Harvard. For exchange rate here, it's also consistent with other researcher, the past researcher like Bantidis and Cheryl 2012. Government deficit financing is positive relation and is significant here. It's also it's also proved that Mozit and Laron 205 also say the same thing. For the checking here, multi-correlation, you see the result here, the highest is 0.38, the lowest is 0.8. Therefore, it concludes there's no multi-correlation. For heteroscedasticity here, the result shown that there's no heteroscedasticity. For autocorrelation here, there is an autocorrelation. So after we do some adjustment or autocorrelation by change of the first difference in all variable in EView, the result 0.275 often is higher than the 5%. So in conclusion here, basically we talk about the CPI, GDF, loan size are positive and significant, and for CAR ratio and leverage, negative and significant relation. And the major implication for this particular one is it's important financial crisis expected to be happen, so bank can use this model. And what they call the limitation is the data of the annual report prior to 2009 is not accessible. And lastly is we talking about the future researcher, study we can study to cover for factors where not tested and to cover more area and cover a wider cross section, a longer and different period observation and different set of data. Basically, I finished my presentation. This is a Q&A section.